Moving on to our next topic, Mars. Usually, risk is associated with returns. So low risk is equal to low returns and high risk is equal to high returns. But then, there are exceptions to this general rule, wherein an investor can get high returns by assuming low risk. There are two friends, Anirudh and Jaspreet. Both of them invested rupees 1 lakh on 16 December 2013. Anirudh invested in Nifty 500 and Jaspreet invested in a combination of equity and debt. For the period between 16 December 2013 and 3rd March 2015, the markets were booming. Nifty 500 increased from 4756 to 7346 over this period, resulting in an absolute gain of 54.4% for Anirudh and 50.9% for Jaspreet. So Anirudh's 1 lakh became rupees 1,54,458 and Jaspreet's 1 lakh became rupees 1,50,900. Now the market started falling. From 3rd March 2015 until 12th Feb 2016, Nifty 500 fell from 7346 to 5833, resulting in an absolute loss of 20.6% for Anirudh, while Jaspreet's loss was contained to 2.3% irrespective of this big fall in the market. So now, the value of Anirudh's investment falls to rupees 1,22,645 and Jaspreet's investment is worth rupees 1,48,300. Now from February 16 until the end of December 2017, Nifty 500 again increased from 5833 to close at 9491. In this phase, Anirudh got his smile back. His absolute return was 62.79% and Jaspreet's absolute return was 43.69%. So Anirudh's investment value at the end of December 2017 doubled to around rupees 2 lakhs and Jaspreet's investment on the same date was valued at around rupees 2.12 lakhs. So overall, from December 2013 until December 2017, Nifty 500 increased from 4756 to close at 9491. Anirudh's 1 lakh became rupees 2 lakh with 99.55% absolute return over these 4 years, while Jaspreet's 1 lakh became rupees 2.12 lakhs from the 111.75% return over the same time period. So this means Jaspreet made better returns with lower risk since his portfolio was a combination of equity and debt. So how did this happen? This happened as Jaspreet's asset allocation kept changing with the market, because he invested in the NJ Mars DAA aggressive portfolio. So what is Mars? Mars stands for Mutual Fund Automated Portfolio Rebalancing System. It is our in-house investment product developed and maintained by the NJ research team. Mars rests on two pillars, asset allocation and superior scheme selection. About Mars, firstly, it offers a wide range of investment portfolios to the investors to choose from. These portfolios have been designed with varied asset allocations, keeping in mind the risk appetites of different types of investors. Then there is a periodic rebalancing system triggered by deviations in the asset allocation of the portfolio from that of the model portfolio. This periodic rebalancing system helps investors get better returns while controlling the risk. To understand this better, let's go back to our example of Anirudh and Jaspreet. These investors invested in December 2013 when the Mars DAA portfolio had an 80% allocation to equity. But as the markets rose sharply, the portfolio reduced its equity exposure to 40% in March 2015. Due to this change, the fall in Jaspreet's portfolio value was very low as compared to the fall in Anirudh's portfolio value. Then in February 2016, as the valuations became attractive again, Mars increased its allocation to equity to 65%. During this period, as Nifty surged, Anirudh got a return of 62.79%, while Jaspreet got a return of 43.69%. But due to this portfolio rebalancing, Jaspreet got a better overall return than Anirudh. A major differentiating factor about NJ Mars is asset allocation. So there are two types of asset allocations here: dynamic asset allocation and fixed asset allocation. In dynamic asset allocation, the allocation between debt and equity is dependent upon the markets. So when the valuation of the equity markets is cheap, the allocation to equity will be high. And vice versa, when the valuation of the equity markets is expensive, the allocation to equity will be low. So, if an investor has invested in an aggressive portfolio, the equity component can even go up to 100% if the valuations are cheap. And it can even be brought down to 0% if the valuations are expensive. Now, there are three types of portfolios available under dynamic asset allocation: aggressive, where the equity component can go up to 100%, moderate, where equity ranges from 0 to 60%, and debt from 40 to 100%, and conservative, where the maximum equity exposure can go up to just 30%. Now coming to fixed asset allocation. Here, the allocation between equity and debt remains fixed. Under fixed asset allocation, there are 10 portfolios offering equity allocation in the range of 0 to 100%. So if an investor has invested in the Mars E60 portfolio, his allocation will be fixed at 60% equity and 40% debt. Similarly, if someone has invested in the E100 portfolio, then he will be invested in 100% equity at all times. The next unique feature about NJ Mars is superior scheme selection. The underlying schemes of all Mars portfolios are carefully selected on the basis of thorough research done by the NJ research team. The NJ research team carries out a detailed analysis of all the mutual fund schemes, wherein scores are assigned to all schemes on the basis of their performance, where a higher weightage is given to consistency of performance. Then the team shortlists up to 5 best equity schemes on the basis of their scheme score, manager score, and AMC score. This entire process is repeated every year to ensure that the funds not performing well are weeded out from the portfolio and are replaced by better performing funds. Next is rebalancing. Portfolio rebalancing means periodic buying and selling of securities in the portfolio with a view to restore the weightage of equity and debt to the original or desired. In Mars Dynamic, rebalancing is done twice a year, in the months of March and September. During the rebalancing, the asset allocation of the portfolio is revised based on the output given by the NJ research model. During the March rebalancing cycle, the scheme change is also done on an annual basis, as discussed earlier. In the fixed asset allocation portfolios, there is yearly rebalancing. The asset allocation is rebalanced back to the original allocation along with the change in the scheme. For example, an investor invested in the E60 portfolio in the month of March. Now equity increases to 70%. So the system will redeem this extra 10% equity from the portfolio and bring it back to the original 60% along with any scheme changes. Next, why Mars? You should suggest NJ Mars to your investors because, firstly, it is a complete investment solution for them. Whatever may be the ideal asset allocation, based on the risk appetite and investment needs of an investor, NJ Mars has a custom portfolio for all. Let's say it is about a middle-aged investor who has some long-term goals and a reasonably fair risk appetite. So the ideal asset allocation for this investor on the basis of these characteristics is 70% equity and 30% debt. So generally, for arriving at this ideal portfolio, the investor may be investing in equity mutual fund schemes or maybe shares of companies for fulfilling this equity component, and in debt mutual fund schemes or other debt instruments for this debt component. And that is not the end. The portfolio will change when the market value of these investments will fluctuate. So now, the investor will have to exit from one asset class and enter into another asset class to maintain this ideal ratio. Or, the investor may simply invest in a 70-30 Mars portfolio. The investment in debt and equity as well as the periodic rebalancing transactions will be taken care of by NJ. The second reason behind why your investors should invest in NJ Mars is superior scheme selection. For an individual investor, it is not always possible to select and remain invested in the best schemes. So this investor is better off by investing in NJ Mars because the underlying schemes in all Mars portfolios are selected and continuously monitored by the NJ research team. Hence, the investor is ensured that his portfolio has well-researched quality mutual fund schemes at all times. Thirdly, an investor should invest in NJ Mars because of elimination of behavioral biases. When an investor invests on his own, he seeks to maximize the returns from his investment. With this view, the investment decisions he takes are based on emotions and judgment rather than research and process. So these behavioral biases creep in to influence these investment decisions. In the 2007-8 bull run, when the market sentiment was positive, so the investors started investing their money at high prices. But when, in 2008, the market started falling, people started withdrawing their investments rather than investing more when the prices were low. Behavioral biases as a result of the market sentiment led the investors purchase at high prices and sell at low prices. And hence the investors made huge losses during this period. In Mars portfolios, since the process is system-driven, it weeds out all such behavioral biases. So, the investor's money will be invested in well-researched funds which are laid on strong fundamentals, plus the money will be well diversified among few schemes. Next we have the different types of portfolios that NJ Mars offers to different types of investors. Under dynamic asset allocation, there are three types of portfolios available: aggressive, moderate, and conservative. In aggressive portfolio, the equity allocation can go up to 100%. So this means when the markets are favorable, it can even be a 100% equity portfolio. This portfolio is suitable for medium to high risk profile investors. In the moderate portfolio, the equity allocation can range from 0 to 60% and debt can range from 40 to 100%. So this means even when the markets are favorable, the equity allocation will be capped at 60%. The moderate portfolio is suitable for low to medium risk profile investors. And lastly, we have the conservative portfolio. Here, the maximum equity allocation is 30%. So even in the most favorable markets, the equity component will be very small. The conservative portfolio is suitable for low risk profile investors. Next, we have the fixed asset allocation portfolios. Under fixed asset allocation, we have 10 types of portfolios where the equity allocation ranges from 10 to 100%. You must note that here the allocation between equity and debt remains fixed. So even if the allocation changes due to valuation gains or losses, it will be rebalanced back to the original allocation. So there are 10 fixed asset allocation portfolios. The first one is E100, which is a pure equity portfolio. E90, where the equity allocation is fixed at 90%. Similarly, E80, which is an 80% equity and 20% debt portfolio. E70, which is a 70% equity and 30% debt portfolio. And so on until E10, which is a 10% equity and 90% debt portfolio. So the portfolios with a higher equity component are suitable for high risk profile investors, and those with a lower equity component are suitable for low risk profile investors. So to summarize, Mars offers 3 portfolios under dynamic asset allocation, the aggressive, moderate and conservative portfolio, and 10 portfolios under fixed asset allocation, ranging from E100 to E10. So Mars offers a wide range of 13 portfolios in total for different investors with varied risk appetites. The latest addition to the famed Mars portfolios is the Mars Balanced Portfolio. The Mars Balanced Portfolio invests in 5 best performing balanced schemes, thereby ensuring proper diversification for the investor. Also, the portfolio keeps on changing on an annual basis where the poor performing funds are replaced by good performing funds. So, Mars' balanced portfolio is a better option to give to a customer looking to invest in balanced funds. Lastly, we'll talk about the business opportunity in Mars. Mars is a very strong product for building business.